right, so thank you all so much for coming. I know it's early, like post-pandemic, you're kind of like, okay, how's this gonna go? Asking people to come out this early, right? So thank you all so much for coming. So I want to just fill out the room a little bit. How many of you in here have either you're where you're at now, you deal with employee benefit plan audits, or at some point in time in your career, you've been through an employee benefit plan audit? Kind of, yeah. My clients that have to raise their hands because they've dealt with me. I'm the one that's poking them, and so it looks like a good chunk of you. That just helps me kind of fill the room. Just gonna helps me know kind of the parts I want to take a deep dive on, and maybe some of the parts where sorry, I swear every time I test the clicker and then there it goes. Just had to wake it up. Okay, so real quick, just talk about Larson and Company, who we are and what we do. So we've been auditing employee benefit plans here at the firm for over 25 years. We are a member of the Employee Benefit Plan Audit Quality Center with the AICPA. I know that's a mouthful, but it's voluntary. And it just, what that means is by us being members, it holds us to a higher standard. We focus on training our people and a few other things that entails. So we're proud of that membership. We audit over 800 million in plan assets. That equates to about 40 benefit plans that we do the audits for. The majority of the benefit plans that we audit are defined contribution 401k plans, but we do have some ESOPs and health and welfare plans within scattered in there too. And then we are Utah's largest CPA firm, meaning we are a local firm. We have offices throughout the state of Utah, 3 offices, but that's a little bit about us. I did also just really quickly want to mention, I'm also the vice president of the Western Pension and Benefits Council, and I just wanted to let people know that first off, if you work for a plan sponsor, for example, people who work for Security National, we would love for you to come to those meetings, and you can come for free. And then also SURE members could join Western Pensions if they're interested for half of the membership price. The full membership dues are $200 a year, but SURE members could join for $100 if they're interested. And John Walsh is on the board with me there. So just a little plug for Western Pensions, because it's also a great organization for content for employee benefit plan professionals. So I just wanted to make sure I mentioned that briefly. And with that, we'll go ahead and dive in on the things I'm going to talk about. One thing I just like my disclaimer, just a reminder that I'm presenting information as it stands today. I'm going to go over some audit standards and also some regulatory updates, and just a reminder that things are always subject to change. That's what keeps me kind of in business, right? So change is hard, but that's the realities we face. So I'm going to talk a little bit about why it's important to have a qualified auditor for your benefit plan. Some standard audit requests and testing, just kind of a what to expect. Talk about some common plan audit findings, and hopefully some things you can do to prevent those from being findings. And then I'll go over a regulatory update. If time permits, we'll go over the new audit standard. But at this point, that should have been implemented and everybody should have seen the effects of it. But I did want to leave the information in the slides. The slides will be available to you after. So if by chance you did have some questions about that and we don't get to it in my presentation today, the information will be there for you on the slides. So, hey, let's dive in. So why is it important to have a qualified auditor? A couple of things here that I care a lot about is it's helping the plan administrator carry out the legal responsibility and to file a complete and accurate Form 5500 for the plan with the Department of Labor. Evaluates the strength of the plan's internal control over financial reporting and identifies plan operational errors and protects the financial integrity of the employee benefit plan. So those are 3 big reasons. So how do you know if the plan auditor is qualified? So here's some common questions you should be asking regularly, either if you're changing auditors or just even of your auditor each year. So talking about the number of plans audited, on that one, I'll just throw out a quick statistic on that. The Department of Labor, about every 5 years, they do audit quality studies. And what they found when they do those audit quality studies is typically if a firm audits less than 5 benefit plans, that's where their highest efficiency rate is when it comes to your audit following professional standards, work paper documentation, things like that. And typically they say after a firm audits about 20 benefit plans, between 20 and 50, that really is the spot where you should feel pretty comfortable, pretty confident that the auditor knows the specialized information. These audits are very compliance focused, compliance driven. So about 20 benefit plan audits, I would say you should feel pretty confident that your auditor knows what they're doing. There's exceptions to everything, because you could also maybe have an auditor that audits 5 and does a fantastic job. But that is what the Department of Labor's data has shown. The types of plans audited. So if you have a defined benefit 401k plan, for example, those are much more complex and actuaries involved. You want your auditor to be auditing defined benefit plans because they're unique, have some unique aspects. So what types of plans do they audit? Making sure that they're actually doing audit specific training for benefit plan audits. Ask them if they have a peer review report where we get audited by other auditors. If that's not the most boring audit that you'd ever heard of. But it's something we get really excited about. Happens every 3 years, and you want to ask if they had any findings in their peer review report. And also the Department of Labor will randomly or not so randomly select auditors for them to come and look at our working papers. And we've been selected for that once. And we also got selected for the most recent audit quality study. And we passed with shining, we didn't have any issues, but that's something you want to ask if the Department of Labor's ever had any findings there from the firm. Audit Quality Center member, we talked about that. And obviously getting client references. So like my exclamation point at the end of this section is that the Department of Labor can assess penalties on plan sponsors. So it's not the plan that pays the penalties, it's the actual plan sponsor, the employer. They can assess penalties of over $2,000 per day that's indexed annually for inflation. That's why I didn't give you the exact dollar amount, because it's even end like with $4 at the end once they index it. So, but that's without limit. And that's if an auditor's report is missing, like you didn't attach it to the 5,500 with the filing, or that it's deficient, that they didn't do a good job on their audit. So $2,000 per day without limit, that can get to be a real number in a real hurry. So I did have a client, we were coming in after the fact to try and help them get compliant, and they ended up having to pay the Department of Labor $75,000 because they had filed their 5,500 without an audit and it had been a few years. And so that, like I say, that was well after the fact. We were trying to help them get back in compliance, but that was really an unfortunate use of funds for that company. So the Department of Labor wields a pretty big stick. Any questions on that section before I move on to the next piece? Okay, great. All right, so let's talk about what to expect, right? What are some of the audit requests and what the heck are you guys doing, right? What's our goal? What are we trying to do when we're doing an audit? So I know this list is small, but it's fairly inclusive. And sometimes I put it on here because I think it helps people give a pretty good picture that these audits are fairly involved, but if you're prepared, we can be in and out of your lives in like 2 days. That's the reality for us. If we, if we're all on the same schedule on timing on when we meet our deliverables, the time that we're really spending face to face with you can be really quick. But these are a good, pretty inclusive list of the things that we ask for. I think the last item, the access to personnel files, sometimes this one kind of catches people off guard and they're like, wait, that's super sensitive information. As an HR director, an HR employee, I'm told to like guard that information with my life. So why do you need to see when this person's pay was approved or their raise was approved, things of that nature? And for our participant data testing and our payroll testing, we have to get pretty down in the details just for our sample, 10 to 15 participants. But that is one where people are like, I don't want to give you that. And we understand that, but it is something that we do have to look at to make sure that participants are in fact eligible, that their the wage base is correct, and things of that nature. So that last one kind of catches people off guard sometimes when we start asking for personnel files, but we make sure we're bound by the same confidentiality standards like an attorney is, where we have to keep all of that information confidential as well. We scrub that wherever we can from our official documentation to make sure we're protecting people's information as well. Okay, so let's talk about some of those standard testing areas. So they really fall into about seven categories. I can do math. I am an accountant. 7 categories. So let's go and just talk about what are our goals when we talk about the testing we need to do in these areas. So first, participant data. So our goal here is we want to verify that the employee-employer contributions were withheld and remitted appropriately. Pretty straightforward, you would say on that front. One thing that when I'm training new auditors, when we're training new auditors on this type of auditing, our materiality threshold in this area is $1. So the Department of Labor has no materiality thresholds. Like when you're looking at an error, when you're looking at a finding, maybe you can get the IRS to say the $75 de minimis rule. I sometimes see that. With the Department of Labor, they don't care. They don't care if it's $5 because $5 for one person could mean your whole population is wrong and you've got a bunch of participants that are missing funds in their benefit plan account. So it's bonkers, but usually we like to have an understanding of differences for anything over $1. It's only for 15 participants, but that is another sticking point when people are like, you're kidding me. You want me to explain why they're $5 off? But then we can find out they didn't withhold and contribute on anyone's Christmas bonus, and they should have. So that's kind of a scenario, but we'll talk a little bit more about things like that when we talk about common fund errors. So contributions, our goal is that contributions are put into the plan on a timely basis and complete. This is another area, the timeliness of contributions, where there's a lot of confusion around what is the standard, because once you're a large plan filer, once you've broken that 100 eligible participant mark for your plan, then you have to transfer the contributions into the plan as soon as the assets can be reasonably segregated. So if that's not gray enough for you, that means that each different employer, the Department of Labor would come in and say, hey, for a few pay periods, you transferred these contributions to the plan the same day you did payroll. Guess what? Your new definition of reasonably segregated for your company is now the same day that you run payroll. So the confusion there too is a few years back, the Department of Labor and the IRS agreed on like a safe harbor for small plan filers. So you have less than 100 eligible participants, and they said, hey, you have 7 business days to get those transferred into plan. That's your safe harbor. That only applies to small filers. So the problem is I have a small filer who now they've transitioned to being a large filer. They got over that 100 mark. Now the rules are different for them and nobody tells them that. That's the problem, right? You don't know what you don't know. So then they're in a world of hurt that first year we come in and do the audit because there are at least 7 business days every time. But there was 3 or 4 times when maybe the person that is in charge of transferring it did it early because they needed to go on vacation. And now they reduce the number of days that they can actually do it. So that one's a sticky area. People don't love when we tell them they have to pay in lost earnings to the tune of like $20. Again, the numbers we deal with here, people are like, Diane, you're crazy. But the Department of Labor said so. So that one's a little bit of a sticking point. So just my guide, our guide on that is don't do it too early and then do it the same time every month or every payroll. So okay, investments. We want to look and make sure that investments are tying up to the certification and that income's allocated to participants appropriately. So most of the audits we do, your asset custodian is certifying those assets so we can kind of limit the procedures that we have to perform around investments as long as that certification is accurate. That helps keep the cost of your audit down. So loans, we want to make sure that loans are issued in accordance with the plan document. Are they allowed? How many loans is a participant to have outstanding at any point in time? What are the dollar minimum and maximum thresholds? How long should the loan be amortized? Things of that nature. does the spouse have to sign for consent for the participant to take out the loan? And those are all dependent on what the plan document says. That's what we look to there. And then rollovers, are they allowed? And then are they, the rollovers in, did they actually make it to the participant that they should have? And what investment options did the participant say they wanted that rollover to be deposited into? We look at that. Distributions, make sure that they are permitted by the plan, and then are the appropriate taxes and fees taken care of with, and also forfeitures. If your plan has a vesting element, or your safe harbor plans, that becomes less of an issue. But if you have a vesting element, want to make sure that forfeitures are handled appropriately. And then our last one, expenses. This is another fun one because we look all the way down to the participant level to say what expenses were allocated to that participant and were they reasonable and in line with fee agreements and the plan document. Sometimes the plan will pay all the expenses or the plan sponsor will pay all the expenses, but a lot of times there's like a basis point quarterly fee based on that participant's investment balance that does get charged directly to the participant. And we just have to make sure that that's being done fairly and correctly. Okay, any questions? I know I'm kind of breezing through things a little bit, but what time are we at? Just want to make sure I'm.
We've got about 15 minutes
Okay.
until we start, getting some final questions.
Why did that? Perfect. Okay, any questions on that section? Just common audit areas, what we test, what we're looking at.
I have a really quick question.
Sure,
About the
yeah.
forfeitures.
Yeah.
Do you know if there's a time, is there a timeline that the company has to utilize those forfeitures once they know about them, and what would that be?
Yes, there is. And the requirement there is really you should use those forfeitures it's pretty quick.
Okay.
But I think it really should be within the plan year that the dollars are forfeited. A lot of times we see it that it's probably the first quarter of the next year because that's when your TPA tells you, reminds you. So yes, those need to be used quickly. And if those aren't getting utilized, that's something that that will be a finding in your audit, especially if the balance is getting bigger and bigger. And then for using those, just as a quick addition to that thought, you need to look to the plan document on what those forfeitures can be used for. So forfeitures, you can use those if the plan document says you can to offset future employer contributions. So it just reduces the cash amount that the employer needs to contribute on a future contribution. Or you can use it to pay plan expenses. So a lot of the times that's how we get paid for the audit, because if your plan document allows it, you can use forfeitures to pay for plan expenses, but you have to look to the plan document on that. But yes, that's a great question on forfeitures and something that can get overlooked, but hopefully your record keeper, your third-party administrator is reminding you about that. So great, thank you. Okay, we'll move on to some common plan audit findings. So these are the most common things that we see, especially when it's the first time a plan has been audited. And 9 times out of 10, it is because you don't know what you don't know. Ignorance is bliss, all the things, right? So, but we get to come in a lot of times and be the bearer of bad news, but I'd much rather have it be me than the Department of Labor or the IRS. So we're here to help make sure that if and when the IRS or the Department of Labor come and look at you, they'll be like, you guys know what you're doing. You've got this figured out. So some areas to really pay attention to, make sure you've got these shored up if you are preparing to be audited for the first time. So first area is definition of compensation. This one is a big sticker. And really what we see is it's training. That maybe you've had turnover in your payroll person, your HR department, and they're not really trained on how your employee benefit plan directly impacts the way your payroll is set up. So the most common thing we see here is people think you can say, I don't want to pay tax on bonuses. Okay, just making sure I was awake. I'm awake. Don't do that to me. Okay. So making sure that people understand that bonuses are part of the compensation base for your employee benefit plan, for your 401k plan. Your plan document has to either explicitly exclude it or explicitly allow for people to elect out of it. But the other thing with that is you have to watch out. If you're a safe harbor plan, you could be messing with your definition of compensation to qualify as a safe harbor plan. So lots of intricacies, but just make sure that you're reviewing that and that there's good training so people understand what should be the compensation base that people are allowed to contribute to the plan on. So that one's a little tricky sometimes. Your elective deferrals were not timely deposited. I was on my soapbox a little bit about that before, but the best way to prevent this one is especially if you outsource your payroll, make sure you coordinate with your payroll provider or internal, your payroll department to say, what's our process? What is the day in conjunction with our pay date that will be the best date to get those transferred into the plan? So having a process and making sure everyone understands the importance of the process will really help you avoid things here to make sure that you are meeting those timeliness requirements. And again, small plans, you do have a 7 business day safe harbor. Large plans, there is no safe harbor. But if it's 15 days after the month the payroll was ran in, you're late. That's the only thing they'll tell large plan filers. They'll tell you when you're for sure late, but they won't tell you when you're actually on time. So that one's a little subjective and it depends on each company and their processes. Next one is pretty common too, that people just don't realize that you could be talking about the benefit plan in a board meeting or in a committee meeting. But if you don't take minutes of that, that is a problem. There need to be regular meeting minutes. The IRS expects to see it. The Department of Labor expects to see it because this is a good gauge of how well and how much you're paying attention to the governance of the plan. So if you have a benefit plan committee that meets, or your investment advisor comes in and does your benchmarking, your fee analysis for you, your investment analysis, right? At least annually, that should be happening anyway. A lot of your investment advisors will actually, when they come and have that meeting with you, they'll take minutes for you. So those are my favorites because they make sure there's at least minutes from one meeting during the year. So I think sometimes people are meeting and they just don't think about it, that there should be minutes kept of the meeting. So, okay, next couple here, missing documentation for employee elections and changes. And this one's getting harder and harder in our world that's increasingly 100% digital, where everything's happening online. You don't have access to it. You're not in charge of the process. So what we look to in those scenarios is your service providers, your outsourced service providers, your record keepers and your TPAs, they have organization control audits done. They're called SOC audits. We rely pretty heavily on those in the digital world and the digital environment, where what do they say? How do they verify that the person that's logging in and making changes is actually the plan participant? And then what are they doing behind the scenes? Are there change logs? Is someone monitoring those change logs, making sure that the changes are implemented correctly? Those service organization control audits become pretty integral to our audit in the increasing digital environment that we're in. But if the process is, there is a paper trail or electronic document trail, then we'll need to see that. Like I say, when employees are changing their rate on the rate they want to contribute to the plan. Also, if people's pay changes, there's pay raises, things like that, we're hoping that there's some sort of formal documentation within their personnel file showing that that change was approved and implemented correctly. So those are some examples where maybe we're not seeing good documentation around documentation for participant elections and changes. All right, exclusion of eligible employees. So this one is always tricky, especially like, you know, if you have turnover and the people that are over your onboarding and things like that, sometimes the benefit plans just kind of get forgotten about. So making sure you understand what the eligibility requirements, you know, is there an age and service requirement? And then also, what is the plan entry date? That is dictated by your plan document. So is their plan entry the first, the first day of the month following them meeting eligibility requirements? Is it quarterly? Is it once a year? So making sure you understand those things around eligibility, and then you have a solid process in place to get people enrolled into the plan as soon as they become eligible. And then hardship distributions. This one, standards changed 2 to 3 years ago around what does the plan sponsor, the plan administrator have to document when someone is requesting or taking a hardship distribution. First thing, you need to make sure your plan allows for it. Again, that's dictated by the plan document. The next piece is, before it was kind of putting it on the plan administrator to say, you have to determine if they really have a financial need. Now they're saying you can take your employee's word for it. You just need to get it in their request documented and in writing. It does, the standard, the requirement does kind of say the gentleman or gentlewoman requesting the hardship distribution, if you know they have like a yacht and a mansion and 2 vacation homes, you probably have some knowledge saying they probably don't meet the financial need requirement. So that's really as far as it goes. And like we said, if the employee sends an email making the request for the hardship distribution and they say why, like what are the buckets, right? That can be like medical, first-time home buyers, a few other things that they specify the reason why, and that it lines up with the 6 or 7 categories it needs to fall into, and you need to save that email in their personnel file. And that's about where it stops for responsibility for the plan administrator. So that's been loosened a bit, but we had some plans that got themselves into some real trouble because they were letting people take hardship distributions when it wasn't even allowed. So tricky. Oh, yes.
So are those things just coming out potentially in an audit? If that's what you're saying, if you're to get audited, those are things that they could look for, and you have to have some backup documentation to show why that distribution occurred?
Yes, it's something we're required to look at when we select a sample of distributions for the year. So we try to make sure we have a good like cross section of the different types of distributions, because it could be like a qualified rollover, right? They left the employer and they're taking their plan balance with them to the new employer. But then also we would look to say, are there any that were hardship distributions? And then we would look at that to say, is there documentation around what was the reason? Does the plan allow it? What was the reason? Does it line up with the requirements that are set by the IRS? And then if those things weren't met, then it would be a finding in our audit.
And is this hardship distribution the one that was granted due to COVID?
So that is a good example.
Okay.
And that is something that the CARES Act specifically then created a new category essentially of hardship distributions, but it was a very set time frame.
Okay.
So that's
this is different?
It is different in that these existed before that, and that was in addition to.
Okay.
There's also some provisions around if people are in an area where there's a natural disaster, there's also some rules in place that will allow people to take a distribution from their benefit
And
plan.
is that a loan, or is that just not getting taxed, or?
It is taxable. So they don't have to pay the early withdrawal penalty. So typically if you're younger than 59 and a half and you take a distribution from the plan, there's a penalty and it's taxable, right? Because this money is put in before tax. So great question.
Okay, so taxable, but I was
Yeah,
thinking. penalty,
taxable. It is taxable to the participant,
But not the 10% penalty.
but you don't have to pay the early withdrawal penalty if it's a hardship distribution. Great questions. Love it. So yeah, the CARES Act created a type of hardship distribution specific to COVID, but that ship has sailed. That was only during 2020 for a specific window of time for the CARES distribution. So great questions. Thank you. Okay, I believe this is my last slide on this. Did anyone have any other questions on common audit findings? And then I'll move on to the last section. So, okay, we'll dive into some regulatory updates here. So we'll talk about CARES Act. It's in the rearview mirror, but there's a few things we still want to make sure we're paying attention to. Secure Act, and we would be like, Diane, what about Secure 2.0? I didn't even talk about it because who knows what the heck's going to happen with Secure 2.0. It's back and forth every day. John will probably talk a little bit about that for us. So, and then some new Department of Labor cybersecurity guidance, which is the first of its kind from the Department of Labor. So we should pay attention to that. Okay, CARES Act. Again, just a reminder, these are the four main provisions. And again, these are in the rear view mirror, except for you could adopt these provisions of the CARES Act and you didn't have to formally amend your plan document in writing until after. They gave you some breathing room on actually getting your plan amendments in place for the adoption. So it was supposed to be the end of this year, but lucky us, they extended it. So it is now the end of your plan year 2025 that you have to get your formal plan amendments in place. I'm hoping most of you took care of that, especially with the restatement cycle that happened this July for your prototype plans and things like that, that your plan record keeper, your plan service provider got that all put into place, hopefully as part of that process. But if you're like, Diane, I don't even know what you're talking about, you should probably talk to your plan service provider and say, hey, do we have formal plan amendments in place for the CARES Act provisions that we adopted? CARES Act was optional. So if you didn't adopt any of the provisions, you don't have to worry about these plan amendments. I think the other one I wanted to remind you here is just a reminder that if people did take that COVID distribution, that hardship distribution, people did have the option to pay that back into the plan over a time frame. They could do it all in 1 year. They could do it over 3 years. The plan participants need to work with their tax advisor to decide what was the best plan for that, if they want to pay it back into the plan. So y'all could see some weirdness. You're like, what is this? Why did this money come back into the plan? And it's because they were allowed to pay that back into the plan if they wanted to. So that's something else to just keep in mind on what's something that's still kind of continuing with the CARES Act, some of the CARES Act provisions. Okay. One other thing I want to talk about that is still ongoing, and I looked yesterday to see if there was any updates on this, but what the CARES Act did is it said that if you have transferred contributions to the plan late, and it was specifically because of COVID-19, your whole payroll and HR department that were responsible for transferring the contributions all got COVID and were in quarantine. I don't know what the scenario is there, but it was specifically related to COVID-19. I mean, when the businesses were shutting down and everything, that was pretty obvious why. But that is still a provision that if it's due specifically to COVID-19, you don't have to count that as a late contribution. And that will run until the president cancels the national emergency. So in February of this year, the president extended it beyond March 1, 2022, and that's where they stopped talking. It was beyond, and I don't know, they didn't give any sort of definite due date on that. And John, if you know something I don't, let me know. But I looked out there and couldn't find anything after that February 2022 announcement. It's still considered to be a national emergency as far as I am aware. So this is still a provision under the CARES Act. Okay, a couple highlights on the Secure Act. Biggest reminder, if you have long-term part-time employees, Secure Act says, starting in 2024, based on your data tracking for the prior 3 years, starting with 1/1/2021, if you have long-term part-time employees who worked at least 500 hours over the last 3 years, you have to allow them to enter the plan and make participant contributions on 1/1/2024. So they do not have to be part of the match. You don't have to contribute. Any employer contributions are not required, but you have to let the participant enter the plan and make participant contributions. So raise of hands, who has long-term part-time employees at their companies? Okay, so this is just a new data tracking point. If you haven't started tracking it, you got to go back to 1/1/2021 and get your tracking updated and in place. Because if they've worked more than 500 hours over those last 3 years, you've got to let them enter the plan. So that's a big deal for 401k plans that was as a result of the Secure Act. Again, the deadline for actually putting your plan amendments in place for the things that are required or even optional adoptions with the Secure Act, those formal plan amendments have to be in place by end of plan year 2025. So that got extended also from end of plan year 2022 to end of plan year 2025. So that got extended. PEPs were created. I won't go too much into that. And then there was some increase in the cap on contributions for your automatic enrollment and safe harbor plans, that the max that you could increase people's rates, the auto escalation on the rates was increased. Oh, see, and I thought that's what I was talking about. I just jumped ahead. I was so excited about this one. Okay, we already talked about the first one. There's a lot now there, it does allow if someone wants to take an in-service distribution for childbirth or adoption expenses, that's now an option under this with the Secure Act. And then the other big one was that age when the required minimum distributions or RMDs have to start for retired plan participants. It went up from 70.5 to age 72. And that was only for individuals who had reached age 70.5 by 12/30/19. But now, currently, anyone, once they reach age 72, you need to start your RMDs. Yeah, perfect. This is my last slide. So we can distribute these slides and it's out there on the Department of Labor's website. But like I say, this is a release from the Department of Labor that this is the first time they've ever given any cybersecurity guidance. ERISA has explicit things within it that says that you as a plan sponsor, plan administrator have to be complying with when it comes to cybersecurity, data security. So the DOL put out some best practices and guidance to make sure that you're compliant with ERISA. They also put out a best practice guide for plan participants to make sure they're being smart and protecting their data. So it's out there. I also have it if you want me to send it to you, but that is the website where that information is available. So with that, we'll open it up to any questions. If anybody has any questions on what we went over. Okay, and on the regulatory side, John's going to give us some good legislative and regulatory updates. So if I missed anything, or if I said anything wrong, just tell me later, okay? Don't tell them. So with that, thank you all so much. I really appreciate it.